Hi, welcome to another edition of Sector Spotlight. I'm David Talbot. I work on the industrial team with sector head Jay Van Skyver. Today we will talk about our sector. If you have any questions, please submit them in the comment section below the video player. With that, Jay, take it away.
Great, and thank you for joining us for a very special Passover version of Sector Spotlight. I'm Jay Van Skyver, I'm the industrial sector head here. We don't have, a lot of this is meant to be Q&A focused, but we have some slides that we want to run through, just kind of outlining the current industrial environment, what we're seeing in terms of the big picture trends and performance, and then we'll talk a little bit about process and a couple of specific areas where I've gotten some questions, so maybe I'll head off some Q&A with some slides that we've incorporated. If you look at slide 3, a great coincident indicator of activity in the economy is rail traffic. I believe a little man known as Warren Buffett pointed that out. And you can see that we've had a nice rebound in rail traffic, certainly since the election. So as I think our macro team has pointed out, it's not just optimism about Trump. Actually, coincidentally, probably mostly unrelated to the election in many ways, you've seen better industrial activity in a lot of areas. You can see we had Norfolk Southern added when rail activity is bad and you sell rails or exit, or most of the alpha sort of disappears as rail activity comes back. We currently have Kansas City Southern as a long, though, basically looking at some of the issues around border adjustment tax valuation and potential consolidation in the rail space. If you get CP and CSX, you might get KSU as a target for an NSC or Burlington. Looking at slide 4, we go through a little bit of what the driver of that better activity is. No surprise, it's coal. Coal is in a bit of a secular decline. That's not new. It has been in secular decline for well over a decade and a half at least. And the reality is that it's going to remain a big part of the utility mix for the United States. There's really no way around that. And you know, it goes up, it goes down. We've simply had a big, abnormally large drop, and we've had as comps ease, an abnormally large rebound. Looking at slide 5, what's a good indicator, like stripping out some of the coal and other factors? We get intermodal freight, right? Intermodal is a little bit more consumer-oriented, broader, not so tied to things like coal. And what we see is, it's up. It's not up a lot. It's actually up mostly on easing comps, but it's not bad. Low single-digit growth. So we're seeing some improvement in some of the coincident indicators. If we look at orders, orders are a good leading indicator of where the economy is going to go. Slide 6, you can see durable goods orders, X, the more volatile parts of defense and aircraft. And we see a very similar trend. Low single-digit growth on pretty easy comps, right? So not amazing, but definitely better than it was through 2016 when we had an industrial recession. One interesting phenomenon that's developing, they're all interesting, I'm sorry. I didn't mean to suggest there was one that was more interesting than another. All these slides are fascinating. Slide 7, you'll see the price of iron ore. This is something I think we call, I don't know what we call, we certainly were involved in the mining capital spending bust and looked at growth in iron ore production. But we saw a pretty sharp bounce off the early 2016 lows in a lot of commodities, and iron ore is among them. And what I think our macro team did, which was very important in their most recent macro themes deck, is sort of call that in the first half we're going to see a peak in the reflation trade. Or this sort of bounce back that we've had in commodities. I think the issue for commodities in general is there's a lot of supply growth, as you can tell from that chart on the lower right, which is not updated since we first published it, but it is definitely a factor that tends to depress prices. When commodity demand growth doesn't grow all that much over time, not that variable. Supply apparently has been quite volatile in something like iron ore. Another good indicator for the industry sector, the thing we look at typically most often, is actually ISM new orders. It's a so-called soft data point. It actually doesn't correlate all that well to the sector over a long period of time, but more recently it has, right? So one thing that we saw is a real spike up that I think is probably more election related in ISM new order. This is the diffusion index they put out. And initially we saw a really sharp spike in the industrial sector, this is the relative performance, right? So how much basically industrials is outperforming the broader market. So the total market's been pretty strong. Initially, industrials were very strong after the election, and then it's kind of faded back, right? There's a lot of reasons why that has faded. But we went from, if you look at slide 9, a very overbought condition, in the industrial sector to one which is merely, less so, and to some extent supported by some strengthening data, right? You call it easy comps. The reality is the data looks a little bit better. It's not remarkable data, but particularly for late in the cycle, it's fine. So we're going to get some growth. Another big factor that I think led to better performance in the sector, and at least initially through the end of last year, was simply short covering, right? And in some names like Deere, we think this is an opportunity, right? So you saw a lot of shares of Deere covered. When you have a high short interest name, a lot of the industrials through 2016 were heavily shorted because we were in an industrial recession, right? So you go out and you short. You get a big short covering, like who bought $15 million shares of Deere, right? Well, shorts did. So I think that's an important dynamic. Our strategy is to short squeezes in high short interest names. Works pretty well historically when we've done it in Deere. The problem is you have to cover, when they press down. Shorts want to press weakness, so a story's coming unravel, right? It's a Valiant or whatever. You want to short the weakness, and I think in high short interest cyclicals and long down cycles, you generally want to short squeezes and cover weakness because you're expecting a down cycle. When you get it, that's not a press moment, that's a cover moment. Looking at a lot of the issues on slide 11 in the sector have been driven by policy, right? So the idea is that manufacturing is dead in America and we don't make anything anymore, or whatever sort of the narrative is. The reality is that in manufacturing in the United States has been just fine for investors, right? Some of this is sending production overseas, whatever it is. And you've seen a broader increase in margins across the economy. The industrial sector has been an outlier within that trend of higher margins across the market or across corporate America. And if policy changes significantly with something like a border adjustment tax, I think it's more of a risk to this trend than anything else. I don't think it's a particularly positive one. But instead, looking at slide 12, what we've seen in some of these themes is policy disappointments, right? So tax reform is looking increasingly challenging. The border adjustment tax seems increasingly unlikely, right? Deficit neutral infrastructure spending is not a reality. That's not something that happens. The problem with infrastructure in the United States really is maintenance, stuff that tends to drive deficits. Revenue producing infrastructure is not something that has difficulty getting funded in the United States. We have a deep municipal bond market, other funding mechanisms, and sort of the lack of healthcare reform and the budget flexibility that would have created probably puts some stress on the potential for tax reform and infrastructure more generally. We'll see how that all plays out. I suspect we'll see motion on some of them, but the sort of scale and the nature, particularly the border adjustment tax, something that got factored in very strongly to a lot of industrial names because they were, basically the target of the legislation. And those themes sort of are fading, right? We're having a little bit of a reset of expectations for a 20%, corporate income tax and no imports, right? Or, basically a heavy taxation of imports and a real export-driven, I don't want to call it a subsidy because that would seem political, but whatever you call it, no taxes on export revenue. So that seems to be fading. What we do see is some emerging new pockets of what we call like irrational exuberance, right? So one thing that is increasingly we've always been asked about like self-driving trucks, right? But we're increasingly seeing, very rich valuations in anything that relates to robotics, automation, and that's a great theme. I don't mean, the problem with narratives is that they tend to be true. In the .com narrative, it's like the internet's going to change the world. It did. It just wasn't that Webvan was worth like 100 times, fake earnings that they never had, or whatever the valuation of market expectations get out of line with some of the economic reality. So, something like a Rockwell, we would love to do a long deck on that at some point, just not here. And is one to keep in mind because eventually these things cycle back and everyone hates them for some, new reason. I think also something like self-driving trucks. What's more likely? Will you see a self-driving train or a self-driving truck first? My bet would be on a self-driving train. It's a closed system, and that you'll see the cost advantages there probably before you'll see it in trucking. It's a lot simpler problem to solve. Another thing that we've seen is real optimism about recovery in just machinery in general, whether it be Deere is the most notable, one of our favorite shorts. Caterpillar has lowered guidance 3 times, was halted intraday and raided by the FBI. and its share price is still higher than it was before the election, which is insane, right? If you think about that, just like put that in context. If you had had like a future newspaper and known the future for Caterpillar, they were going to lower guidance 3 times, including halting their stock to lower guidance, you probably would have shorted it in fourth quarter, and you probably would have been wrong, especially with the FBI raid. And I guess was that January or February. Anyway, not a good situation. Interesting to see if we'll get a Caterpillar update on potential settlement for their tax liabilities in this upcoming April earnings report. So that's another major thing we've seen. We see a lot of overvaluation in, or probably excessive optimism within the machinery group in general. Deere has been one that we've seen. You saw that in MSC Industrial, which we added in February as a best idea short. February 21st was the first time we got it. We got the all-time high close. It's like never happened to me. I've been doing this for a long time. Probably should have put that on the screen. The other thing that we've seen a bit of the fading of the Trump trades and a bit of motion into those. There's some places that are really out of favor. So I think we have seen something like KSU, Kansas City Southern. That's the Mexican-American Railroad, basically. Although there's a lot of other rail exposure to Mexico trade. Across the rails, like a Union Pacific, everybody's exposed to Mexico. They're more so. The sort of fear of policy risk in a name like that, I think, has kept the valuation still relatively attractive, even though a lot of the other names have rallied. We have Finning. Everyone likes the idea of commodities stabilizing. The reality is that Finning, Caterpillar's largest dealer, will do a lot of the service on that equipment. So an aging fleet tends to be very good for them because there's more parts and service. It's not like everyone's going to run out and buy new mining equipment with 20% of the fleet idled, but they may do maintenance as their fleet ages. That seems very reasonable. Textron, long, very, very rich people. If you get pass-through entity tax reform, things like that could be great for them, and they're still recovering from the financial crisis. Aerospace segment. So those are a few of the themes we see so far in 2017. So one of the things that I think, the reason actually I do this job is to try and convey this sort of perspective, is understanding cyclicals. I think it's very important not only for investors but for management teams and employees to understand how cyclicals work. So if you look at slide 13, I think why we don't care that much about policy change becomes very evident, right? If we look at something like global shipbuilding, so this is shipping tonnage added per year. What you see is a big spike as basically World War II generates a lot of conversions and additions to the global shipping fleet, right? So you see all that on the left side, you see this big spike in tonnage additions. But, ships don't last forever. They wear out. They salt water and steel, corrosion, and you get a big replacement cycle. Ships last about 30 years. You get a big replacement cycle about 30 years later. About 30 years after that, peaking in 2011, you see another one. The reality is that no matter what Donald Trump does, it is not going to impact how quickly the shipping fleet ages, right? And whether or not you have a lump of capacity that wears out at the same time. This manifests itself in some very strange ways. This not just in shipping, but in general aging of capital equipment. Like in 1974, the AAR changed the life of a rail car, of the life over which a rail car could interchange between railroads from 40 to 50 years. 40 years later, that has an enormous impact, which is, by the way, the next 10 years, of rail car demand. It has an enormous impact on replacement demand. So when you actually get into this kind of a process, a little more nuanced, shipbuilding is a very clear example on 13, but it's a pretty good perspective to bring to the sector, because no matter what policy is, no matter what politicians are doing, no matter what capital allocators are doing, managements, they can't make people want to buy ships. Can't make people want to buy tractors. You have to need tractors. Slide 14, you can see the second part of the process. So the first part of the process, we try and get the right side of that cycle, right? Get long ahead of a replacement cycle, short value traps on the other side. The second part of it is to get the industry structure right. So shipbuilding is a terrible industry structure. Half of industry capacity was added in the last 15 years by Chinese competitive entrants looking to boost economic growth. Third part of the process is, so you want to be short bad industry structures, long good industry structures, right? Third part of the process is to wrap the first two into valuation, right? So what we're looking for is a significant valuation outlier. industry structure tells me something about long-run margins, right? You can be pretty sure that if you're competing, if half your industry is government-subsidized Chinese competitive entrants, that you're not going to be loving your margins in a labor cost-intensive industry, right? It's just going to be bad, right? And if you're in a major down cycle like we are in shipbuilding on the previous slide, you know, your revenues are going to be under pressure. And we can see that in orders and backlog and things like that. So if you look, you know, this is more than like a philosophical example. It's a great, very clear example of process, but we actually had in our launch deck Samsung Heavy as a best idea short. There's an update from 2014 where we explain that we use this example over and over and over again to explain process. So I'm sorry if you've already heard it. But I think one thing that's important too, on slide 13, is to note that those up cycles and down cycles go on for like 15 years, right? They're not short-term things. People say like, oh, we're gonna wait out the cycle, right? I used to hear that in Caterpillar in 2012, right? We're gonna look through the cycle. It's great business, we're gonna look through the cycle. And on slide 15, you can see that it's been literally 5 years since we, this will be 5 years in July for the note. We didn't launch Hedgeye Industrials until basically July or June or July of 2012. So we couldn't have been a lot earlier, but you know, basically 4 years and 10 months later, retail sales for Caterpillar are still comping negative. Even last month, that little tick up is really just because it had a comp on a negative 20. The worst year-over-year month was February of 2016. So February 2017 looks better. It would still be down 6 if it were against January. So the point is that these are very, very long-term things. They're not things you can wait through. And who knows, maybe Caterpillar will go back to, they will never go back to peak demand. Like you don't go back to peak, but maybe it starts to stop comping so negative eventually. Another example, 16, you know, we look a little bit at age of different infrastructure. So there's the age of private railroad transportation equipment. Fleet demographics are destiny. Apparently Yahoo Finance ran an article this morning showing that we have Steve Bannon's favorite demographer who works at Hedgeye. The reality is that he's an amazing colleague and he's got a great book and he has a really interesting perspective on how things work. I like demographics in fleets, right? So when everyone just bought railroad equipment and they have a lot of young, new excess locomotives and rail cars and signaling equipment and PTC equipment, it's all new and just installed, you can be pretty sure that it's, you know, that they're not going to go and buy a lot of new stuff. And also, the fleet can't get younger forever. A fleet that's getting younger is one that's seeing investment above replacement demand, right? So in the long run, these are no growth industries, they're sub-GDP growth industries. When suddenly the fleet gets, you know, the age of the fleet gets cut almost in half or whatever, down 2/3 or by a third, what you're going to see is a period, even if it just stays at, you know, whatever it is, average age of 14 years, a significant slowdown in spending because you would just go back to normal spending and it would go back to normal aging. And I think that's something that people miss a lot in cyclicals. And when you see a chart like that, suddenly it's very clear that, hey, rail equipment's really young, that's weird. But anyway, that's something else we have. You also in WabTech have what we'll talk about next, which is steel costs. I just put on the same slide so it was organized, but you can see materials costs as a percentage of COGS there on the right. That was a key part of our second half view for WabTech as a short, which is still one of our, since I guess March or something, February, March of 2015, we added it as a short. And you can see, you know, they got a significant tailwind from lower steel prices. Here's what that looks like for Deere, which, you know, has like a 6-month lag or so between when a move in steel prices impacts their P&L. Because the reality is the tractor's not made of donuts, right? They're made of steel, and you have to buy the steel with money that goes through the cost of goods sold. So when somebody like the CFO of Deere is telling you that they're taking out costs and it's not the 40% drop in steel, they're probably not being entirely forthcoming, right? 40% drop in one of your largest input costs matters. And what you saw across the industrial sector in 16, particularly the middle, the second half of 2016, was a lot of companies out touting these fabulous decrementals. We're managing, you know, Caterpillar, WabTech, Cummins, Deere, they all had these cost-cutting narratives, and they all are big buyers of steel that got this gigantic tailwind from lower steel. So I'm really curious to see how Raj and company handle, particularly in their fiscal second quarter, I guess their fiscal third quarter. We'll get May, we'll get the second quarter for Deere, and then August they'll ruin everybody's vacation again with their fiscal third quarter earnings report. They report like on Thanksgiving in the middle of their terrible reporting schedule. But we'll see how that plays out. I think I know that they'd still buy steel and it's not going to be pretty. And that they've dug themselves, just like Wabtec did, into this cost management, whatever, continuous improvement. You know, the reality is that, you know, Deere makes tractors. They've been making tractors a long time. They're pretty good at it. There isn't there isn't going to be a loss of economies of scale where they're going to make fewer tractors for more money. That's not how manufacturing works. So I think that is a very interesting thing to watch across the sector through this year. One question we get a lot, this is just throwing this in because we figure it would be interesting to the general public, is looking at auto sales, right? So one of the things we get pitched a lot, I get pitched a lot of short theses and long theses, and they're usually really, really smart. And you know, one of the problems with the auto short is just that auto sales on a per household basis just aren't that elevated by historical standards. My theory is that as millennials have children, they'll buy a car because that's when I was forced to get a car and grow up. You know, the reality is that the fleet is also pretty old. If you look at the average age of light vehicles there from Wards, there's some slightly less, I don't know, something less old version of it from the BEA age data, but you know, mostly you're not looking at a super young fleet. When you look at the rail car fleet, right, super young, also has these weird things that happened in 1974. Something like light vehicles, they're still aging, right? So it doesn't look, you know, super overinflated as a recovery or a cycle, and that would be a reason to be probably less bearish on autos if you just put, you know, if you just plug something like the auto OEM industry into our process. And with that, we'll take some questions. Our rapid fire pass over Q&A.
Not rapid fire just yet. We'll have a couple longer questions and then we'll get to the 1-2 answers. Sorry about that.
You'll have a rapid fire, very like four-letter answer.
Okay, fine. What fundamental characteristics are you looking for in today's environment, especially with respect to inflation's rollover?
So the thing we look for on the equipment and machinery side are old fleets, and on some of the, you know, more flow-oriented things. So like Praxair, you know, where like literally it's flowing, or you know, something like a finning where you have parts going out where just activity is cyclically depressed, where in the long run or on a normalized basis, activity probably needs to be higher. I mean, so mining companies are not buying a lot of parts. That's, I think, an objective reality because they're taking parts off of idle equipment. That isn't going to work. Eventually, those pieces of idle equipment will have no parts to take off, or you'll need a part that you've already stripped off an idle piece of equipment. So over time, you will see a normalization of spending on aftermarket. So that's the kind of thing that we're looking for on that side. And then on the other side, we're looking for just old fleets. Like if we look at water infrastructure is another minor. Like if we've been planning to do a Xylem long deck for like 2 years,
Forever.
and Xylem always stays ahead of our ability to say like this is a great spot, and then it turns out it was a great spot. But something like water infrastructure in the U.S. or infrastructure in general, streets, roads, and bridges, are old and will need to be replaced at some point. So you know that's one of the tricks. Like you could have said the rail equipment fleet was, you know, young for a while, right? So what do you look at to call an inflection? You look at orders, right? So you need a very clear inflection in the underlying demand drivers. So orders, funding of like a big infrastructure program probably would be a great inflection for the aging infrastructure. And I think people get whipsawed by the scale of the spending shift, that to stop the aging of streets, roads, and bridges or water infrastructure, in the US would be really, really expensive. It would be a very, very large increase in spending. So that is the kind of thing we look at on the long side.
Yeah.
And that was the question?
Sure.
Does it specify long or short?
Yeah. You briefly touched on Finning, but could you just go quick walk through your thesis? Any updates there?
Probably. So Finning is Cat's largest dealer. If you want to be rich, be born into a New York real estate empire, or be born to a Caterpillar dealership owner. Probably less flashy, but cat dealers make money. They very consistently make money, and you're a monopoly in your region. So you have the monopoly on cat parts and service, and pretty much you get stuck doing that, particularly if you have something under warranty. So Finning has Western Canada, the good mining parts of South America, and the much less profitable UK and Ireland. I don't know how it could be so unprofitable for them, but it is. They basically underperform every other Caterpillar dealer in terms of profitability, particularly in Western Canada, and the UK and Ireland is a real outlier. So even ones in regions that are theoretically struggling, like Australia and South Africa, they're not really. They're doing just fine, and Finning has largely underperformed them. So one thought is that there could be an activist campaign to try and break up Finning because it's huge and it's got these disparate, unintegrated regions. Another idea would be that they have a lot of internal improvement. They got a new management team in late 2015, and they're implementing a plan to sort of turn the business around, closing facilities. I think they have a bit of the old monopoly problem where you don't manage the business too tightly because why bother? Like you have to fire people and stuff, and that's hard, so you just keep running. And then thirdly, just the aging of the fleet. You currently have one of the youngest mining equipment fleets out there with a lot of idled equipment. As that fleet ages and the idled equipment is parted out or goes back into being utilized, you're not going to sell a lot of new equipment, but you will see increased consumption of parts and maintenance on that fleet of that installed base on which they basically have a monopoly. So I think those are sort of a few of the points that we've made on Finning. Great franchise. If it were valued the same as its Eastern Canada rival Toromont, which is just I think it's like Paul Jewers, the CFO at Toromont, just do a call with him. He's like one of those rare guys. You're like, oh my God, you are like 190 IQ and you're running a cat dealer. How did this happen? But it becomes very clear where that comes out in the valuation, because if Finning were valued the same way Toromont is, it would be more than I think a double last I looked. It's a significant increase, a significant discount to Toromont that Finning trades at because they underperform their Eastern Canada rival. And then if you talk to the Mock, who is the contrapositive of the CFO at Toromont, who's the IR rep at Finning, who will now never take my call again, I'm sure. But he'll explain that mining is the reason that Toromont outperforms Finning, but of course Finning's highest margin regions are in mining regions, and mining is obviously a great business for them. So yeah, it's, I think, infinitely fixable and a great franchise. It's a little small for a lot of institutions, and it's in Canada. But we flag weird idiosyncratic risk where we can get it.
Great. One last long question for you. What feedback have you received so far on MSM?
Well, we got a lot of questions about, so we did a black book. MSC Industrial is an industrial distributor like Grainger or Fastenal. Actually, they're very different. They're much smaller than Grainger, and they're very metalworking focused. And then Fastenal has more stores, and they're not as much of a catalog business. But MSM was very, very richly valued. And we've gotten a few points of feedback. We added it to Best Ideas on the 21st. I remember that because we actually got 105 and they missed numbers and it's down. And you remember all of the names you get right, and you remember none of the things you get wrong in this business, right? That's the nature of it. But we did get some requests for doing a mass analysis of price comparisons, which we are working on. It turns out to be quite difficult to do. In practice, typically even if a bulk purchase on MSC Industrial will be at, say, a 10% discount to, or 10% premium to Amazon, and most purchases are in the 30 to 40% discount range for sort of small spot purchases. So that was a request we got. There was a lot of concern that MSM could be bought by Grainger. I think that's really unlikely at that valuation, because any way that Grainger pays for MSM is going to be pretty dilutive. So typically these industries, this industry is under assault by price transparency. Everybody can stand in front of you and Google what the price of a product you're buying from Grainger or MSM is from the sales rep. You have a sales rep, which is overhead relative to Amazon and web-based platforms. And it is increasingly hard, I think, to bundle and work your way out to a higher margin and get that kind of flexibility. So most of the feedback is that the work we did on Amazon, the competitive threat, the narrative there, that was good, but that we could have more detail on the specific, full SKU comparison on price, which is very hard to do technically, as opposed to the sampling approach we took, and concerns over acquisition was the other big piece of feedback.
Great. Awesome. Well, I think it's time for the rapid fire round.
Jesus.
Awesome. What is your favorite short?
Deere.
Favorite long?
Probably Kansas City Southern right now.
Yeah. MSM's biggest competitor?
Themselves. No, it's still probably, Grainger and Fastenal have both pushed into core metalworking. But I would just say the internet and price transparency in general. Or I guess the other thing we spent a lot of time going through on our deck that I don't think people appreciate is how competitive the independents are. We just have a whole call about MSM. That these guys have, anybody who hasn't heard of sort of the trade groups in this industry, like AD, which it takes forever to figure out, is affiliated distributors. They're actually the largest purchasing group in industrial distribution. So affiliated distributors are actually the ones putting the most price pressure, per MSC Industrial's most recent conference call, on the industry, because they actually are, I think they get like $34 billion in buy, not a small competitor, and that's just like a co-op of independent competitors in this industry, very important. So I would actually say AD is probably their most important competitor.
All right, well, let's speed it up here.
Is that too slow?
It's too slow.
Oh,
It's too many words, Jay. Sorry. Who has the best management team?
I don't know.
None of them. None of them.
No. There are good management teams out there. There are brilliant managers out there. I think that in the sector, if you are, the CEO standing at the right place at the right time, I don't want to mention names because it's kind of mean, but you look like a genius, right? Because suddenly the shipbuilding cycle takes you up, and then you're on the other side, and you say Doug Oberhelman, and you look like an idiot, because the reality is everybody stopped buying mining equipment. Now, I'm not defending that individual. They made some very critical mistakes and I think damaged the culture of Caterpillar, but I think it can be very hard to evaluate management teams independent of that. I'd say Cummins has been a notable, amazingly successful management team in a very difficult industry, so I'll mention them.
Who has the worst management team?
Caterpillar. Oh no, I take that back. I will say something controversial. I think Deere currently has, this will become, I think, quite popular. The Deere actually is, everybody loves Deere. They think they're doing a great job. I think that they have been very aggressive in it with their financial services subsidiary. We have a full deck on this. That their investor presentation that they give out presents what I consider, in my personal opinion, to be supported by data, a misleading picture of the history of that segment in terms of losses, which they define in a way that I think investors wouldn't expect them to define it. And when they look at write-offs, there's actually, the Daily Show is not on this week, but there is a great Stiefel initiation on John Deere that came out today. It is hilarious. It is worth a full week of daily shows. And they actually, so basically a third of Deere's profit comes from this finance subsidiary, and they just copy and paste in this report the Deere version of events for historical losses without any critical analysis of that. Whereas we have an entire slide deck devoted pretty much to just critical analysis of that. So I think that they could end up going down, particularly because some of the things they've done on conference calls, like last August when they, after Q&A, announced a $500 million cost-cutting initiative at the end of Q&A. Like, thank you all for dialing in. By the way, we have $500 million in cost cuts that'll come over the next 3 years. Click, right? Yeah. That kind of crap pisses people off, and I think when people understand how misleading some of their reporting has been, their inability to explain things like steel costs, I think there will be a tremendous backlash. So that's my answer. Everybody knows about CAT. They already got raided by the FBI. Or not, whatever. Who raided them? I don't know. It's like IRS. The Coast Guard or somebody raided them.
Yeah. So, would you short Deere here?
Yes.
Great.
3 letters.
Does CAT have a cultural issue?
Definitely.
Yeah.
And I think that's really, I think that's one of the problems in these kinds of big cycles, right? Is that they do a bunch of short-term stuff, like, I don't know, write a bunch of leases for farm equipment to get themselves through the first couple years of a down cycle. I know, I'm just picking on Deere because I was thinking about Deere. But like CAT certainly went out of their way to do some lending. The mining finance division of CAT Financial, they made some real efforts, and they changed the accounting for pensions. They do this, they do that.
Dump some rail equipment parts in the ocean.
Yeah, dump rail parts. So I mean, if you look at CAT's list of investigations, we have an SEC investigation for Bucyrus accounting. They have the California. They have a subpoena from the Department of Justice California branch for dumping train parts to hide evidence of unneeded railroad repairs or something like that. There's a whole list of investigations. And it does look like there's a cultural issue. Like, that's not normal. Like at Hedgeye, like, if we don't submit a presentation apparently 3 hours in advance, like, we get terminated now apparently. So it's a very, it seems like a very toxic culture dealing with that kind. When you see your friends get fired, when you're trying to keep your share price up, meet your obligations in a way that you just can't, occasionally, management teams go for external flexibility.
Yeah. Here's an interesting long-term question. Will railroads and trains disappear over the very, very long term?
No.
No. Great. Awesome. Well, that's...
well, I mean, they're much cheaper than trucks, so no.
Awesome. Well, that's all the time we have today. Thank you for watching. Tune in next week at 2:30 with another sector spotlight with our retail team. Thank you.